Today, we are diving into the latest piece from the Averaging Up collection. This article offers a truly fascinating analytical framework that fundamentally reframes how we observe market events. Typically, as investors and observers, we are naturally drawn to the highly visible spectacle of an asset. We focus on the widely anticipated arrival that captures all the headlines. But the true structural power in the market usually lies in the invisible mechanics of the underlying infrastructure. So we are going to completely shift our focus away from the main stage and rigorously examine the architecture operating quietly in the background. To ground this concept, the article points us toward Friday, June 12, 2026, the expected date of SpaceX's initial public offering. Now, on that day, the entire market's focus will be singular and pointed sharply upward. The financial media, retail investors, and professional analysts are all going to be fixated on valuations. They'll actively debate revenue models for Starlink, and they'll deeply scrutinize government contracts. Essentially, the entire market will watch the rocket launch, completely missing the actual structural transaction taking place right behind the scenes. But here is where Senator Elizabeth Warren's recent letter regarding large technology companies disrupts this dominant narrative. As the article highlights, she did not write to the founders of these companies. She didn't write to the underwriters. Instead, she directed her scrutiny precisely to the index providers, specifically S&P Dow Jones and MSCI. The address on that letter reveals the true architecture of the market. You see, the fundamental question isn't whether a given company deserves its multi-billion-dollar valuation. The real question is, who controls the gate? This builds directly into a concept the collection terms the rebalancing illusion. There is a pervasive, mechanical misconception in the market that when a massive company finally enters the S&P 500, it inherently creates value for the index fund. That is simply incorrect. An index fund merely exchanges its cash or exiting shares for SpaceX stock at the current market price. It is a forced rebalancing. The investor in the index fund receives a swap of constituents, but the underlying toll collector, the index provider, receives a brand new, highly lucrative stream of revenue. The article breaks this down into a stark, intellectual dichotomy. On the left side, you have the rocket. That's the spectacle. It represents mechanical growth that has to be actively purchased, competed for, and actively modeled. It is a product, and its investors are merely participants in a highly visible arena. On the right side, however, you have the toll. This is invisible. Its growth is delivered to it, completely structural. It isn't just a product, it is the standard itself. Companies like S&P and MSCI aren't participants in this arena, they are the gatekeepers. And that brings us to the remarkably pure revenue model of these gatekeepers. Think about it. S&P Global and MSCI do not build rockets, they do not underwrite IPOs, and they certainly do not execute stock trades. They simply maintain the list. They license these indices to every single fund that tracks them, charging a fee measured in basis points on assets under management. When a massive entity like SpaceX is added to the market, the assets under management tracking that index swell immediately. The toll collects automatically on that increment entirely at zero marginal cost. So what does the architecture of their moat look like? It relies entirely on the fact that an index is not merely a product, it operates as a standard. The index is deeply embedded into the very foundation of global finance. It dictates pension allocations, ETFs, futures contracts, and even corporate compensation packages. You simply cannot build a competing S&P 500 any more than you can build a competing unit of measurement. The switching costs here aren't financial, they are institutional and regulatory. Changing a benchmark requires board approvals and fiduciary consent. The standard itself is the moat. Consider this profound distillation from the article. Nobody pays attention to the guy who collects the tickets at the gate. We are all so rigorously conditioned to watch the show that we fail to observe the hidden power of the invisible infrastructure making the show possible in the first place. And operating completely under the radar is exactly where a structural toll performs best. While the S&P 500 is highly visible, MSCI operates this exact same architecture on a global scale, often entirely unnoticed by the retail public. Yet MSCI quietly defines how institutional capital is allocated globally across developed, emerging, and frontier markets. Once a sovereign wealth fund or a massive pension writes its mandate referencing an MSCI index, the toll is permanently embedded into the workflow. It becomes invisible, structural, and strictly unavoidable. The Averaging Up collection categorizes this rare breed of business using a mathematical framework called the free surfer. Most businesses, even truly exceptional ones, must pay for their growth through capital expenditure, research and development, or marketing. But a free surfer operates simply as A times B. Think of A as the index, sitting perfectly as a structural choke point. B represents the massive secular wave of passivization. The growth here isn't purchased, it is delivered. The secular wave arrives entirely from the outside, delivering continuous, free external growth directly to the toll collector. But the architecture actually goes one layer deeper, into what the article calls the double swell. MSCI was the first to successfully close this loop. It isn't just riding one wave, it is riding two distinct waves that continuously feed off of each other. Wave B1 is passivization. Wave B2 is AI-driven portfolio automation. AI agents inherently default to machine-readable, low-friction indices. Therefore, automation accelerates passivization. As more capital flows into passive vehicles, it demands more complex data analytics and factor scorings, which are in turn served by machines. The loop closes, the swell continuously builds on itself, and it massively accelerates the toll. Now, S&P Global is coupling to this exact same dynamic, but they are doing so specifically through distribution. S&P has strategically integrated its financial data directly with AI agent platforms through a retrieval infrastructure built by Kensho. The data is now consumed programmatically by artificial intelligence. That automated consumption generates licensing revenue. That revenue then funds wider infrastructure pipes, making the data even more accessible to more agents. So an event like a massive IPO doesn't just feed the traditional toll, it simultaneously activates these automated, programmatic consumption loops. Naturally, structural power of this magnitude inevitably attracts political scrutiny, which brings us back to Senator Warren's letter. But the article provides a critical historical constraint. We can look directly at the Durbin Amendment of 2010, which officially capped debit interchange fees for Visa. What happened afterward? Visa's revenue multiplied anyway. Political constraint acts like a vice, compressing the tolls strictly per unit. But because the secular wave continues to massively grow the total volume passing through the choke point, the ultimate mathematics still work entirely in the gatekeeper's favor. The toll survives the letter. Let's synthesize all of this structural analysis by looking at a perfectly parallel historical pattern. During the California gold rush, the miners who actually struck it rich were the statistical exception. The gold itself was highly speculative. The truly durable generational fortunes were built by the merchants who sold the picks, the shovels, and the infrastructure. Today, the asset, the highly visible rocket, is the speculative gold. The infrastructure, the index, is the structural fortune. Which leads us to the final analytical thesis derived from this piece. While the entire financial world will watch trillions of dollars rebalance to accommodate an immense IPO, rigorous analysis requires a different vantage point entirely. The trade is not to be in the index, it is to own the index. As you watch the next massive IPO dominate the headlines, ask yourself, are you captivated by the spectacle, or are you looking for the toll booth hidden in the shadows? This content is educational and reflects a personal analytical framework. It does not constitute investment advice. Visit averagingup.com to explore the full collection.